Well, one long-term bull says growing trade tensions have him the most bearish he has been in a very long time. Let's bring in Jonathan Golub, Chief U.S. Equity Strategist at Credit Suisse. Jonathan, great to have you back. What caused you to turn so bearish?
Well, I mean, and I think that Dan, you hit the point. We are flat for the last year, and if you get away from the gyrations that we have a great 6 months, really on the back of unwinding the fourth quarter, markets don't move forward when you have a meaningful deceleration in global data, period. And the second thing is, well, we want to believe that lower rates are good. When you have rates go from 3.25 to 160 and change on the 10-year, that the market's telling you that there's something wrong. So what do I want to see? I want to see interest rates level off and start to rise. I want to see the cyclical data get better. And we hit our year-end target about 3 or 4 weeks ago with 30.25. Everyone was asking, are you going to push it forward? Do you think it's going to go up? I said, listen, I think that this thing is going to take a breather for a while. And right now, I think that's the case. Longer term, we're not going into recession. There's a lot that's wrong. I don't think we're going over a cliff, but I wouldn't be buying. And by the way, in December, I was screaming, buy into the volatility. I'm not making that comment now.
Do you think yields are going to go a lot lower? And I'm asking you this because so many people are saying, oh, I can see yields going down to 135 to test the prior low, or I can see yields go to 125 or even 1 or whatever, but I don't see a recession on the horizon. And I'm just wondering, what exactly then is the 10-year telegraphing when we go from that high level to 164?
Right. The Fed has inverted the short end of the curve. And until the Fed comes out and says that we are going to fix that, the interest rate is going to keep getting pushed lower until, and it's not whether they do one more or two more. The Fed needs to say, we will not allow the short end of the curve to be inverted. Because what it means is people, instead of investing longer term, are just going to roll 1 month paper over, and it drains liquidity out of the system, and it puts the system at risk. There's a reason why the market hates to see an inverted curve, because it is a problem. So if the Fed gets religion on that, I think that interest rates will rise, the curve will steepen, and I think it'll be good for markets. It won't. There's really two stories, though, that and the cyclical data.
So that's actually, I'm glad you brought up cyclical data again, because nobody thought that yields could go down here. Now that we're down here, everybody says they're going to zero. What happens is the sequencing important. So do we need to get good cyclical data and then yields rise, or can yields rise and give us a signal that things are getting better?
It's a great point, but I think that if the Fed were to let you know that they're actually, this data dependence means that they're day trading the economic data like we are. No, what they need to say is we are going to fix the curve. That we ultimately, and you can't have the futures market saying they're going to move 3.5 and them saying, well, we'll see how it goes. And so if they get religion on that, I'll tell you right now, the 10-year is going to move up and bond investors are going to lose money. Short of that, I think it's going to continue to be here or lower.
What is religion in the context of the reality of Jerome Powell? Is it 50 basis points in September?
Right now, there's almost no acknowledgement that the short end of the curve is being inverted because they're holding the overnight rate way too high. And so they don't need to say we're doing 3 or we're doing 4. What they need to say is this is an important part of our objective. If we believe
we're going to defend this.
Well, it's not only defend, but if we want to see growth in the economy, we can't have an inverted short end of the curve, and that's important to us. If they say that tomorrow, I'll tell you right now, you're going to get a pop in yields, and they don't need to move at all. So I mean, eventually, but in the near term, they don't need to.
I'd like to forget the Fed for a second, because I actually think that the market's an atheist right now. The market doesn't believe the Fed. I think the Fed's rendered itself irrelevant. Your stock picker, your strategist, in this environment where we stay at 165 or we go to 135, there's certainly been some sectors that have outperformed and have traded, and there's been multiple expansion here. So where is it?
Well, I mean, I kind of think about the market as having 3 buckets. You have a growth bucket, and how many growth stocks in the S&P 500? 35 of them. It's a really narrow list. You have these stable, relatively low growth companies that you have in utilities and telcos and staples, and people can't believe that the PE is so high on them. But these are like bond proxies. But the S&P 1.9 dividend yield, and the 10-year is 30 basis points lower. Anything which smells like a bond is too cheap, and they're going to keep going up as long as you have this environment. And then anything that looks remotely cyclical until that data turns is a dog, and I would stay away from it.
Hey, Jonathan, what would it take for you to feel more confident or have more clarity on 2020 earnings?
Well, so here, let's take a look at what's going on right now. The revenues are fine. Revenues are growing at 3 or 4%, not an issue. The buybacks are strong, and you have a margin issue around 3 issues. You got a dollar problem, you have an oil problem, and you have a big tech margin problem. And ultimately, though, the average company, the median company in the S&P, looks pretty darn healthy. Next year, I think, if we assume that the dollar goes away as a headwind in oil and some of these big tech issues go away, I think we'll be surprised. But the market's not paying attention to the earnings story right now. It's all this other stuff.
Have you ratcheted your target down further?
We haven't.
What are you waiting for?
Or what would it take? Yeah.
What would it take for me to?
You're the most bearish you've been in however long.
Yeah, I mean, so here's my optimism, or why I have it. If we look out 18 months, and we were talking before about what's the upside case. The yield on the S&P, dividends and buybacks, is like 3.8. The S&P is so cheap compared to bonds that when you get investors buying stocks for yield instead of bonds for yield, I think ultimately the valuation of the market has to go up, but you have to wait. And listen, if you said to me 2-3 years out or 18 months out,
sure.
I just don't know how much longer the cyclical data is going to stay weak, and I don't have to be early on this one. But if you said to me a year and a half from now, the stock market's going to be higher than this.
All right, Jonathan, good to see you. Thank
Good to
you,
see
Jonathan
you.
Golub of Credit Suisse. What do you think about this TINA valuation for the
Well,
markets?
it does make sense. And I mean, when you think about it, I think the yield thing came into play really hard when we saw this dramatic drop in the 10-year so quickly. Listen, bubbles get created all the time because of this. We know that the staples are going to be really, really expensive, trading at 25 times, no growth, all that sort of thing. I guess the concern for me is that when you talk about the market right here, we just didn't have the confirmation of the new highs. We had a new high, a new all-time high in the S&P 500 last month, and we didn't see the AGA of MAGA. We only saw Microsoft. You didn't have Apple, you didn't have Google, and you didn't have Amazon.
AGA of MAGA.
Yeah,
So
the
MAGA
AGA
minus
MAGA. You didn't have small caps.
Got it.
You didn't have industrials make highs. You didn't have the banks. And you say to yourself, what the heck is going on here? Because there doesn't look like a heck of a lot of broad strikes, in my opinion.
Can we, I think, just cut to the chase here? If you listen to the conversation on the desk tonight and you listen to what the new strategists are saying, if you removed this sense of that there was massive black swan systemic risk in the world, wouldn't stocks be a buy here? I mean, what are people? I mean, people
What do you mean
are acting.
what do you mean by black swans?
My sense is people look at Hong Kong, they look at unprecedented territory.
You would still have slowing global growth.
People are of the view, not that equities are falling apart because earnings are falling apart because the U.S. economy is going straight downhill. They're looking at these other factors and they're assuming there is a black swan on the horizon, not looking at fundamentals as they are right now.